tonight's all about bringing together both traditional finance and decentralized finance to exchange insights, directly from people with first-hand experience in the realm. And to get us started with that, we have an extremely esteemed panel covering a few topics: technology, security, of course the investment opportunity, and the regulatory future that awaits us. So, with that being said, I'm going to hand it over to our panelists to introduce themselves, who they are, where they're from, and what their topics of interest are in this space specifically. Starting with you, Kelly.
Okay, hi. My name is Kelly, and I'm from Julius Baer. So I figured to wear a hat because it's great advertising for my bank. It's forever the camera will remember us. I am the deputy head of research. So in my day job, I do macro research, rates, bonds, equities, everything. In my spare time, which is quite a lot, which takes up a lot of time, is obviously digital assets. And I will consider myself a crypto teenager because I only started in December 2020, right? There may be some boomers here already in crypto. I'm still a teenager, super teenager. So I'm here to learn, and I'm happy to see all of you.
Hi everyone. Yeah, I'm U-Zyn Chua, CTO, co-founder of Cake DeFi. I'm a dinosaur in the space. I've been a long time in the blockchain, Bitcoin, crypto space. Started in 2009 from a retail perspective. So I got attracted to the space because it's such a revolution in the financial space where you get to control your own financial destiny with this cool piece of technology. You get to see what it does. And from there, throughout the journey, I've been started a few innovations along the way, and Cake DeFi came around in 2019. And we do here is to build a great DeFi interface or UX to make it easy for retail users to get on board into DeFi. And then throughout that process as well, we know what we need to do as institutions to provide this in a simple way to our users. So now we are opening up our core to allow institutions to also do the same thing. So I come from retail all the way to institutions now. That's what I do. Yeah. Thanks. Welcome.
Hi, everyone. My name is Shan. I'm part of the business development team at CertiK. And CertiK is a company focusing on Web3 security. We do smart contract audits, penetration testing, as well as advisory services for institutionals, specifically focused on security. As part of my day-to-day role, I work very closely with different VCs, as well as exchanges and layer ones, to see how we can help secure either the portfolio companies or even projects before they go on listing. Since Kelly started this thread about crypto age, I would say I'm probably even younger in terms of crypto, than a crypto teenager. I joined in 2021 in the crypto industry. That was during a bull run. Took a lot of risk back then and lost about 90% of my portfolio. And ever since, I was like, okay, I'm going to join a security company and see where that takes me, right? So that's a short introduction about where I am and what I'm doing.
Hey everyone, my name is Gabriel. I'm from the Spartan group. And just to give you you guys an overview of what Spartan is, we are a digital asset management and advisory group founded about 5-6 years ago. And on the advisory side, we advise crypto projects and companies on fundraising and M&A transactions. Some of our past clients include players like Solana Foundation, Dapper Labs, and Bybit Exchange. And on the investment side, which I'm working in, we manage 3 funds. The first fund is a long-short directional hedge fund. We also have 2 venture funds, one of which is focused on DeFi, and the other one is focused on Web3 gaming investments. And as for my crypto age, I probably am a boomer in the space. So I started my personal journey in crypto after the Mt. Gox implosion sometime in 2014. So since then there's been so many ups and downs and amazing different developments within the space.
Okay. So clearly we have a wealth of experience here on the panel tonight, and obviously we're going to try and dive into that as deep as we can with the questions we have. But let's start with what the actual topic of the night is, which is titled DeFi Unlocked. And what we're talking about when we mention that phrase is wealth preservation and creation opportunities using DeFi. So to set the foundation, what we're going to do is start with a very, very high-level question. Why did you think there is this renewed interest or new interest on the side of institutions when it comes to decentralized finance in general? You see $48 billion in total value locked right now because the latest figure. You see institutions hiring high caliber talent across all digital assets, specific streams. So starting with you, I think we'll start with you, Gabriel. You have a lot of exposure to this space. I'm sure you're speaking to the traditional institutions as well. Why is there this new interest?
Yeah, I think the main reason is, if I can sum it up in one word, is inefficiencies, right? This is a market that is still very nascent. It's very complex and it's also rapidly changing. And when I talk about inefficiencies, it's from multiple different angles. So, firstly, if you look at from the liquid side of things, like liquid investments, like many tokens right now, they don't really trade in line with fundamentals. You have tokens, for example, that trade way above what the fundamentals would suggest. And, if you guys have been following the space in the past few months, there's been like a resurgence in AI-related tokens. Many tokens that have not much direct relevance to AI. And, their business models haven't changed one bit, but you see them doing like a 5x, 6x within the span of like 1 to 2 weeks. And, just last month, there was also renewed interest in tokens that are related to mainland China or Hong Kong. And, like same thing we observed. Many of them just did like a 4 to 6x without any apparent improvement in their fundamentals. And, on the other side of the spectrum, you also have tokens that belong to protocols that are doing pretty well. They generate cash flows. They, if you look at it from like a price to earnings perspective, many of them actually trade at ratios that are lower than some tech stocks or even like more traditional types of stocks. So there is a lot of like opportunity as a liquid investor in the space, in trying to capture some of these like mispricings or inefficiencies. And I guess like even from a venture perspective, like if you're investing on the private side of the markets, like I mentioned, the space is still very new, and it's changing like every 2-3 months. There are new changes to like on every aspect of the value chain within the crypto stack. So if you are a venture investor and you're able to have a very good technical understanding of the space, and you also have a good handle on valuations, there's actually tons of opportunities for and investors in the space to generate like outsized returns.
Excellent. Now, U-Zyn, I'm going to go to you because clearly we noticed a renewed interest with institutions. This has been a typically retail business for the last 4 years, and now we are diving into this arm. What factored that decision? What's the motivation behind it? What are you seeing with this wave of interest?
Yeah, I think DeFi brings along a lot of revolution to the space. Like it brings a lot of efficiency, increases efficiency in doing financial transactions across different entities. It brings across a very transparent way of doing things, and it eliminates intermediaries in when you do financial transactions. So all this thing actually brings a lot of point to why DeFi is here and why DeFi was invented in the first place. It was started to with retail in mind, but as an institution, when institutions are controlling most of the financial assets, if you look into this, you would see that why are these retail users are getting all the benefits, and then why institutions are missing out on that. So the reason why institutions cannot get into that is because a lot of the tools that we have on the retail side on the DeFi side are meant for retail. Like wallets are designed to be single signatory, and interact are meant to be it's close to like you don't have like multiple parties involved and all that. So this if without all that limitations, I would think that institution would be already on DeFi, because it's just the way that it's the more efficient, cheaper. You had global liquidity across all the tokens, all the assets, and you got a global exchanges that trades 24/7, just way more efficient overall compared to more of a traditional kind of finance. So it's the tools that's missing on that. So with that, I think we can actually bring a lot of that. It's time for that revolution to actually bring all these institutions as well, by not making institution change, but by making DeFi available to what institution expects it to be. Like it needs to be policy, adhere to the policy and adhere to the compliance rule and all that. So I think DeFi in general, it's very attractive to retail institutions alike. And it's about time where institutions are going to get more and more into that.
So we've got the outsiders returns, the emergence of tools that are friendly to institutions, making it easier. So Kelly, you come from a very traditional background, so you have a very unique perspective about this. What are you seeing on your side of these when it comes to interest in this space?
Okay, so as a background, Julius Baer is a Swiss bank. We have $425 billion in assets. And we have the financial interest in a crypto bank called SIBA. One of the two in Switzerland, the other is Signum, which is obviously more prevalent here in Singapore because they are more active. So our clients are able to trade crypto. We can onboard crypto wealth, and so we can do that because unlike our larger Swiss peers, we do not have presence in the US. So the SEC does not breathe down our neck, right? So that's one. So the reason why, from an end user perspective, why there is I would say on a simplest, I'm oversimplifying, okay? Why I think that this is why there's demand for sort of like institutional DeFi. Number one, I think it's sentimental, meaning that everybody has a feeling of FOMO, right? There is something new that can potentially return you a very large amount. So that's one. And that sentimental part actually comes from our term demographics. When I mean demographics, it means that, most of the $425 billion are from older folks that have built businesses. They are brick and mortar. They own buildings, they own lots of stuff. But the thing is, they will not live forever. All of us in this room are not going to live forever, at least in the current form. So they have kids. Their kids are significantly more open to digital assets. Okay? So in terms of the demographics part, inevitably, dad is going to hand something down to you, even if he does not agree that you plunk everything into Bitcoin or Ethereum. The likelihood is that she's going to give you some leeway to put $10 or $5 out of $100 into digital assets. Okay? Why they're willing to do that? I think it's also because they come from a generation that is more risk accepting. They accept risk easily. That's one. Secondly, I'm going to say this, but it might offend some people, but it's just the truth, right? 富不过三代. Do you understand what that meant? That means wealth does not translate past the third generation. So if your dad has a lot of money, the likelihood of you putting risky asset to work has a very, very low cost to you relative to your dad, who slogged through really hard to make that money. So I think we are responding to the demand, maybe not from the parents, but definitely from the kids.
Okay. And so we've covered quite a few things here. Outsized returns, the emergence of new institutional friendly tools, generational change in behavior and transfer of wealth. Shan, I want to ask you, because you have a very unique perspective as well. You're dealing with people who are coming to you with a inherent fear, some of these institutions, because there's a big security and technology risk involved with interacting with these protocols. Are you seeing more and more traditional institutions approaching you, or are they still off the DeFi category? What are you seeing in the market research?
Well, definitely more institutional interest. So actually in the last year, we have seen increasing demand from different institutions coming to us, not just to test out or to ask about the due diligence of the security or of the DeFi protocol that they're investing in, but also on a specific portfolio. They all want to make outsized returns. And this is the prime vertical that they are putting a lot of capital in, and they want to make sure the investment is safe and secure. So a Shan Shan, yes, we do see that that increased demand. It's just that they have a very long process of compliance to be answered to. So I think that process actually limits a lot of big institutional players from entering the market, right? Even to onboard a vendor, it takes about 6 to 8 months for your normal institutions. So to be able to safely enter the space, I think there's still a gap in that right now, but I think it is improving, right? Because outsized returns, you see regulated protocols, and it's just an ever-growing demand in DeFi space.
I want to bring a question forward about the difference between retail and institutional, because obviously we were all exposed to the retail opportunities quite early on, but they're not necessarily the same on the institutional side of things. So starting with U-Zyn, what do you think are the main differences in terms of the protocols and the primitives compared to retail when it comes to institutions?
In terms of the use case, in terms of the usage of DeFi protocols, they are the same. And that's actually the reason why blockchain was invented in the first place. It doesn't discriminate between the poor and the rich, the institutions, the retail users, the young kids and the older person that use it. It's all the same. You get the same chance of earning the same yield. You get the same chance of using the protocol. It all works exactly the same. But on the other side, and on the point where you interact with it, that's where there's a huge difference there, because the tools that were invented so far, I mean, not say so far, but a lot of the tools that we have, maybe 70, 80% of the tools that we have today are designed for individual users, for retail users. So it's designed to be fast, to be interactive, to be in a way less compliant to institutional policy and all that. So it's more fun to use DeFi protocols with the tools that you have, like your in-browser wallets and all that. But for institutions, if you want to do the same thing, it's going to be, either you use a custodian tool and then you move it out to a retail site to interact, or you have to just, I don't know, forgo this entirely. And it's hard to do that. Or you have to change the internal policy to say digital assets, we're going to be a little bit more relaxed. So you can do all that to digital assets, but not for the traditional assets. That would actually, for a lot of companies, that would not fly. So now I think it's a time where, with the heightened interest on institution into the space, it's about time where the tools are also upgraded to support what the companies, what the policies are needed, what the compliance side is needed. So you don't have to be tied down or change the rule internally to support, to do what all these retail users are able to do. So you don't have to change your policy, you don't have to change the rule, and you just kind of do all of that. And also the one thing I want to point out is that a lot of tools make the assumptions that all companies look the same. Like, every company, you have three person to sign, and you just 2 out of 3 to sign. But not all companies work the same. Every single company is unique, and every single company has a different rule. So it's actually very, very important for tools to make sure that it is adaptable and doesn't make any assumptions on how companies operate on the space. So that's a very, very key thing if an institution wants to get into DeFi, to make sure that you don't compromise on your own internal security to fall into DeFi in a way.
Definitely. So a lot of considerations to take. I want to understand from your point of view, Gabriel, what the evolution in the wealth creation and preservation methods have been from when you started, because you were on the burner relatively early. So what have you seen in terms of the changes in those methods and the tools that have emerged as well?
So just to clarify, when you talk about methods, are you talking about like the DeFi primitives, or?
Start with the primitives, and then also what investment unique methodologies you changed over time.
Yeah, so on the primitive side, so I think the first emergence of DeFi, we started to see that happen sometime during the ICO boom, like 2017, 2018. Back then, you had some early inklings of what would eventually emerge as base primitives in the DeFi space, such as your automated market maker exchanges. I believe the very first one was, there was this protocol called Bancor, which was sort of unwieldy to use back then And then Uniswap came in and make it even easier to swap, one asset for another. And then you had MakerDAO back in 1718, which was the very first decentralized stablecoin. So I think over the past 2 to 3 years, the base primitives, which I would give a couple of examples. You have swapping of assets, you have lending and borrowing, you have stable coins, you have the NFT markets as well, and there are many others. So those we've seen leaders within those categories emerge today. And in terms of what we've been seeing from the private investment side of things over the course of last year is that I would say that the primitives can be categorized under 2 broad categories. You have firstly the very crypto native primitives that are coming out. So for example, right now, a very hot topic within the space is the concept of maximal extractable value. So meaning that within a blockchain, as long as your blockchain validators have the power to order transactions, they are able to extract value by ordering transactions in a way that allows them to front run your transaction, or to do stuff that basically extracts value from your everyday user. And there are markets right now, like market primitives right now emerging, that allow people to sell these ordering rights and to kind of open the MEV space to a broader range of actors, so to speak. So these primitives are what I would call like very crypto native primitives that only make sense within the construct of DeFi and Web3 as it is right now. The other category would be what I call like non-crypto native primitives. So many of these primitives are attempts to replicate certain parts of your TradFi plumbing. So you have people that are trying to build protocols that allow you to trade interest rates. You have people that are trying to, for example, create a marketplace where market makers can buy and sell retail order flow. So if you guys are familiar with how Robinhood and some of the other crypto retail brokerages are selling order flow to market makers like Citadel, people are also trying to replicate that within Web3 and crypto. So so on the primitive side, this is what we are seeing as evolution of what has happened over the past few years. And the second part of the question was on how we take advantage of that. So, I mean, there are 2 ways, I guess. First way is to invest in these protocols. You either invest in it from, the perspective of a venture fund. So you invest in early teams. You buy you basically invest in shares of the company, or you buy rights to the tokens, the future tokens of these protocols. You could also buy tokens of existing DeFi primitives off secondary markets. I think the other way to participate in this growth and evolution is to use some of these DeFi protocols. So you can trade on AMMs, you can lend and borrow from some of these lending markets. You can partake in an activity called farming, where basically you get paid tokens in a certain protocol for using the protocol. Sort of like, imagine if when Uber first launched, if you take a lot of Uber rights, Uber hands you like equity in Uber. This is a phenomenon that has really taken off since a period known as DeFi Summer in 2020. I hope that was a good overview.
Kelly, the hot topic that we've seen over the last few months or even longer has been CBDCs, and you've got like 110 countries now exploring this as a potential addition to their central banking system. How do you envision that exploration and this new, emerging technology in the DeFi space changing things as we see it right now? Is it still truly DeFi? Will it have an adverse effect to DeFi? Will it open or close doors in your opinion?
I would say that I'm not, I haven't looked at the topic very, very closely, but so I'll share an oversimplistic view, if you all don't mind. So I would say that if Singapore launches a CBDC, I'm not sure if anybody's going to use it, or if we do use it, it doesn't. I'm not sure if it makes a difference in in institutional DeFi, because our society, where we send money to each other, is quite frictionless already, right? Who doesn't have PayNow, right? And it's zero cost, immediate settlement. So I think in that respect, if a CBDC is launched in a frictionless monetary system like in Singapore, or maybe I'm not sure how the monetary system works in the US, unlikely to have great different. I'm not sure it's going to have a lot of impact. But if it is launched in a high friction country, Argentina or Turkey or something like that, possibly it would have, if the users there have been using using decentralized finance to do stuff, whether lend, borrow, send, whatever. I think that the introduction of CBDCs in those countries could have a negative effect on the system. So that's my opinion. Yeah.
U-Zyn, it'd be remiss of me not to ask you about the same question, given your experience. Would you like to talk about what you've done in this space and what you think the future holds for CBDCs in general?
Yeah, that's so I was involved. I'm actually the lead architect for the CBDC in the Bahamas, Sand Dollar. Worked on that project for 2 years, from ideation, pitching ideation, all the way to launching it in 2019 December. So we did a pilot, and then 2020 is when we launched it. I've left the project entirely. It's still operational today and it's still being promoted today. So from what I can see, CBDC, it's a very interesting experiment, if I will, to kind of introduce a digital money that works. The problem that I see on the ground, I spent some time in Bahamas, is that it creates this weird situation where, so just like Kelly describes, for all these developing countries, there's no banking system, so it creates this need for digital currency. But even with that, it creates a kind of a strange situation where now central banks is kind of providing a direct access to retail customer to have a bank account directly at the central bank, and that takes away the commercial banks in the middle, and it creates this weird situation where, no, just from my point of view, that CBDC, if you want to do it, I think Singapore is taking a very safe and also a very, in my opinion, a very correct stance here, in that CBDC should not be retail facing, because as central banks do not want to allow retail customers to be able to open bank accounts with you directly, and takes away the business of the commercial bank. So Singapore is exploring more into the wholesale CBDC, which in Singapore maybe it doesn't make sense, but in some countries, maybe in the Bahamas, it does make sense, because then it doesn't disintermediate the commercial banks, and there's still business for the banks to direct facing to face the customers. And what it helps the settlement between the banks, so you do not have to wait days, or in the Bahamas case, sometimes they have to carry cash between banks to settle the debts between banks. So CBDC kind of allow that, but I would think it's a CBDC for retail. It's kind of interesting experiment, but it's gonna be very interesting to do it in a country level and to make it right and not affect your economy that way.
We have a lot of people in the audience who are very new to digital assets and DeFi in general, right? So one thing that everyone needs to understand is there's a high security risk involved with this new technology. So you work in that space. So Shan, could you, I guess, detail for us sort of steps it takes to interact with the protocol and what considerations someone who's completely new needs to make?
So I would say if it's institutional, then probably a combination of both proactive and reactive measures. And your proactive measures, like first, you want to think about, you want to do thorough due diligence. And due diligence is not just about how this protocol works, but you want to look at the code. You want to make sure that things like how they're managing private keys is secure. You want to be able to manage internal risk. True. You want to make sure the project team has done proper KYC, which means it's not just an identity check, but a proper KYC when you understand who is managing, who has control to what, and where these team members are hired from. Are they part-time? Are they full-time? How are they outsourcing the developers? So we've done some KYC cases, and the stories are wow. Right? Like last month, there was a Hope Finance attack. It was attack where the team itself they use a multi-sig wallet. So technically, the centralization risk is mitigated. But because all the team members, I think 3 out of 4, they signed the transactions to export all the funds out of the project, there was a hack. Right? So an audit would be able to tell you that the multi-sig has resolved centralization risk or has mitigated it to some extent. But a KYC will tell you who actually has access to the private keys. So the first point I would say, do complete due diligence, manage the operational risk, in terms of KYC, internal threats. Second, this sounds like shilling, but it's not. Definitely have smart contract audit done from very trusted providers. This is crucial because you want to know how the code is being designed. Is it being functioned as intended? We see cases where there's a lot of flash loan attacks happening in space. And all of these flash loan attacks, a lot of them happen because of a flaw in the smart contract code. And that's something that can be mitigated if you work with a very trusted smart contract audit provider. And one key thing to note about this is that do not take security at its face value. So if a project gets audited by CertiK, you can't just say that, okay, because it's audited, it's safe. You actually need to read the smart contract audit report, look at how the team takes the findings, how they resolve it. If they only acknowledged it and they say like, oh, we're not going to fix it, right? Technically it's legal for them to still do that. The report still gets published, but we do call up these findings in the smart contract audit report that maybe they did not fix this. So this due diligence part that institutionals should be making, right? So proactive, the last one I would say it's probably on-chain monitoring. You need to be able to have a system where you're monitoring all of the on-chain activities wherever there's a big outflow of wallet transfer or funds. And I won't mention this big protocol name, but there was a big protocol that did not realize they got hacked until a week later when they reviewed the wallet transactions and they're like, oh, what happened with that? So you must be able to monitor this ideally 24/7. And then when there is a very big outflow, you have an alert system and you can address this directly. And lastly, reactive. So in the worst case possible scenario that a hack does happen, I think the team needs to think about having an incident response plan. So you can work with third-party companies to have a incident response team to assess the situation, work with law enforcement agencies, and retrace back some of these funds when a hack does happen. So that's a quick summary.
So the technology and the people behind the actual protocols. So these are all obviously new considerations. Right? For people in traditional finance, this is unheard of. And there's a new team that needs to emerge when it comes to investing. But U-Zyn, would you be able to tell to us about, we've been running an institution in DeFi, right? So you know more than anybody what happens in this space. Outline for us the steps it takes for a new institution to start participating. And again, what you think would be a good way to mitigate security and technology risks.
Okay. Yes. As an institution, so if you want to get into DeFi, there are a couple of ways for you to do that. One is to look for providers out there, and even there's also multiple ways for you to do that. One is you have a custodian partner where you have all your cryptos with the custodian partner. They have access to your crypto, but you have this relationship or your agreement with them or contract with them that they can only do certain things on your instructions, and you trust that it's safe that way. The downside of that, obviously, there's a trust of third party, there's counterparty risk on that. And then the other way is you have full access to your keys. I mean, not to your keys individually, but spread out across multiple parties. So user custodian providers that allow you to be able to have that control over multiple parties. So they, as the solutions provider, do not have access to your keys, and you are able to use that in a safe and compliant manner. That's on the custodian side. So one is you trust someone else, and one is you trust yourself, but you spread the keys to multiple parties, and even the providers does not have access to your key. That's on the custodian side. But in terms of businesses trying to build something in the DeFi space, then there's a lot more things that you need to think about, actually. You need to think about how you can capture the yield and pass it to either your investors or your users. And that's what a lot of people did in DeFi somewhere that term was being used last 2 or 3 years, that you capture all this yield and you pass it over to your customers, and it works really well until there's some issue or a misuse of fund happens, and then when you get asked where all these funds are, and then it's going to be hard for you to explain that. So if you're building that service, then what you need to do as well to build a good service is actually to think about how you provide transparency, how you provide trackability to all these funds, and what are protocols that a user or your investors are exposed to, so they can actually see that where all these funds are. And these are, it's hard to do that because it's easy to capture the yield and take a cut and then pass it out. But in order to provide all that transparency and still be able to make money out of that, because you need to charge some fee as well, that's a hard thing to do because it involves a lot of work to provide the transparency and to explain to users how to track that on their independent tools. So at Cake DeFi, we started with that from day one to provide transparency. It's also because, I mean, it's from the years that we've been in the space. Like for me, I've been in the space for close to 12 years now, and my co-founding partner Julian's been in the space from coming up to 10 years now. So all of that adds up that we need to provide transparency. It's all this. We know that this industry allows us to provide that. Why not make use of that? Because there's no other financial industry, even if you want to provide transparency, you are not able to do that. So if you're providing this service, then you should think about how to provide transparency, how to provide trackability to your users. And what we're doing today with enterprise is to strip out the core of what have been powering Cake DeFi for the last 3 years, and also just also a matter of fact that we're not affected by the what you hear in the news of like 3 arrows and all that. Because of this transparency and trackability that we have, it protects all the funds from being exposed to all of that. So what we do here at Enterprise is strip out the core so that other institutions can also do the same thing and offer the same service to your investors, to your family fund, to your investors, or to your clients if you have clients that are investing in your fund. So that's key if you want to provide services in the space to your to whatever that you're doing. So it's a hard thing. So choose the right partner, choose the right providers, and you can get all of that.
So we're out of time, so we're going to do a final question around the panel. And in the audience, they have both traditional finance, decentralized finance, some people in the middle, some people not in finance at all. But what is the key message? Everyone is exploring the space. You can at least say that. So starting with you, Gabriel, what is the key message in a sentence or two that you want these people to take home as they continue to drive the demand and explore DeFi in general?
Yeah, so I think the key message that I have in mind is that like DeFi is an open and permissionless ecosystem for everyone to access, and because of its openness, the opportunity set is very wide. You have, anyone in the world is able to build onto DeFi, is able to compose what they're building with existing primitives, and because it's open, it also makes the space very competitive as well. Because you're up against, anyone in any country who is able to access the crypto capital markets without the same restrictions that they would face if they were trying to access TradFi markets. So key message is more opportunities, but also more challenging in terms of the competition.
Well, I would say security comes first. The strength of the DeFi system lies in its security. And security in this space is still very new, to be honest. Like smart contract audits did not even came into space until 5 years back. So security in this space is like a police and robber game, right? Like we are trying every day very hard to find new ways to be able to front run these attacks, to detect, to prevent. But at the same time, the attackers are also finding new ways every day to do various kind of bit phishing, to exploit different protocols. So it's a never-ending game. And I would say always have that in consideration. Do a lot of due diligence, work with trusted partners, very key, and better test the protocol before you really commit fully to it.
I would say I would say that we are still early, despite all that has happened, despite him being a dinosaur. uh, that's one. Secondly, if you are institution, right, just like individual like you and me, you should size your bets correctly. What do I mean by that? So if your institution get into it, you convince your LP or whatever to do something, and then you realize that at 2 a.m. you wake up and I need to check my phone and what's the price. It means that you size your bets too big, and I think that's not healthy for anybody, because people who size wrongly typically do bad things for the ecosystem, right? Not just for yourself, but for ecosystem. So that's what my key takeaway for you is, not just as an individual, but even for institutions, size your bets properly, because we don't want any liquidations here.
Thanks. Yeah, I think the Palace really what I'm gonna say basically sums up what the Palace says as well. Like, do your own due diligence, make sure that the smart contracts or DeFi protocols that you get into are secure. So that part, you make sure that what protocols that you get into, what the blockchains are get into, are audited, and also make sure that if you can, like, make sure that the funds and all that, you can track them and make sure that they're safe. And on the other end, because that's on the protocol side, but on your end as well, if you have funds that you want to get into this protocol, make sure that they're protected by proper security, by multi-sig, by proper policy controls and all of that. And also I also like what Kelly says here, that you should diversify into don't bet everything into one single protocol, and not just bet into one single blockchain. If you think that's a good one, then just put a portion of your portfolio into that and not spend everything into that. Also, if you're into the space, then you are actually one of the you are more adventurous than many, because you are looking for potential in the space, and you want to looking for up and coming new protocols that will change the world. So for that, also you want to make sure that you are able to capture that speed as well. If you wanna look into this thing, so you want to make sure that if you have some funds in some wallets, you want to make sure that wallet is able to adapt quickly to the new protocols, into the blockchains that it supports, because you do not want to miss out on that boat, because protocols come super fast and it gets mass adopted super fast. Like AMM trades, for instance, just take less than a year to get really big mass adoption. So if you're in the space and you're investing in the space, make sure you don't miss that boat by choosing the right tool.
So then obviously a lot to take home, different perspectives, different streams of DeFi, and hopefully that's given you guys either traditional or decentralized sides something as you continue to explore the space. So with that being said, we'll have a round of applause for the panelists tonight. Thank you everybody for joining us.